Very good morning, dear students. So I hope that you are all safe. So last 3 weeks I discussed about accounting ratios, liquidity ratio, solvency ratios, activity ratios, correct? So now we are going to discuss the fourth classification, profitability ratios. Okay, so it's a very important one. Okay, so accounting ratios, we are going to discuss profitability ratios. Here, what is the meaning of profitability ratio? Before that, under profitability ratios, totally 10 ratios available in our NCERT book. The main discussion, totally 5. That was orderly arranged here. So one is gross profit ratio, second one is net profit ratio, third one is operating ratio, fourth one is operating profit ratio, fifth one is return on investment or also called return on capital employed ratio. Then sixth one return on net worth. Then seventh one share earning per share. Eighth one book value per share. Ninth one dividend payout ratio. 10th one price earning ratio. So the NCERT book totally 10 ratios are available. But the main discussion out of 5, 1 to 5. So this video we are going to discuss gross profit ratio, net profit ratio, thereafter return on investment or capital employed ratio. So further another next video we are going to discuss operating ratio and operating profit ratio. Okay, that is the idea here. First we are going to discuss what is the meaning of profitability ratios. It's nothing but financial performance is mainly summarized in the statement of profit and loss. Okay, so analyze the earning capacity of the business with in the outcome of utilization of resources employed in the business. Okay, so performance of the business. So whether are going to do the business in a profit or loss. So what is the performance level? All based upon this profit ratio are going to understood. Okay, so nothing but close relationship between profit and efficiency with the resources employed in the business or utilized. That is the idea here for the profitability ratio. So first one, what is the gross profit ratio? So it is a percentage of revenue from operations is computed to have an idea about gross margin. So relationship of gross profit and revenue from operations, nothing but relationship of gross profit and revenue from operation. When you already you're preparing final accounts, the trading account, you will get gross profit, correct? So from the gross profit, what are the information involved? Purchases, direct expenses, and opening stock or closing stock sales are involved. Okay. So revenue from operations means here revenue earned by the enterprise from its operating activities. See, that is the idea they mentioned here. Here, what is the formula? How to compute our gross profit ratio? Nothing but our total revenue minus cost of goods sold. Nothing but you get gross profit divided by total revenue into 100. Okay. That is the gross profit ratio. Okay. Here, gross profit ratio, how to calculate here? Revenue from operations minus cost of revenue from operations, you will get gross profit. Okay, so how to calculate cost of revenue from operations? Nothing but our cost of goods sold. One is opening inventory, excluding spare parts and loose tools. We have to omit that, okay, in the inventory. Then we have to add our net purchases, then direct expenses minus closing inventories. Here also we have to excluding spare parts and loose tools. Okay, so opening inventory, closing inventory, very careful whether they mention spare parts and loose tools. Okay, once they mention, we want to exclude that. Okay, to add all together, we will get cost of revenue from operation. Okay, so other point of also how to calculate cost of revenue from operations. Cost of materials consumed plus purchase of stock in trade. During the year, what is our purchases? Plus changes in inventories of finished goods, work in progress and stock in trade. This we already discussed, correct? So what is the changes in inventories of finished goods, work in progress and stock in trade? Nothing but difference between our opening and closing. Okay, finished goods, opening finished goods, closing finished goods, there is a difference. Work in progress, similarly same manner, opening work in progress, closing work in progress. Similarly stock in trade, opening stock and closing stock. The differences you want to mention here, plus direct expenses or revenue from operation minus gross profit. Okay, that also we will get it for the, suppose sometimes they given gross profit. From that gross profit, how to calculate cost of revenue from operation. These are the 3 examples they given here, 3 way of calculation of cost of revenue from operations. Okay, then what is the objective and significance? To determine the efficiency with which production and or purchase operations and selling operations are carried on. For this objective and significance. So guide for fixing selling prices and efficiency of the trading activities. So it is a given gross profit ratio gives guide for fixing selling ratio. What is the MRP? It should be adequate to cover operating expenses, dividends and to build resources. And also compared with the ratio of earlier years, our past records with that of earlier firms to compare and assess the efficiency of the business of the other firms. Okay, when compare with our last year or previous year, similarly our other firms also, the comparison for gross profit ratio for previous year and current year. Okay, that is the objectives. So what is the reason for increase in gross profit ratio? That's normally speaking, so highest selling price with constant cost of revenue from operations. Nothing but cost of goods sold. Naturally, gross profit ratio increased. So our MRP, our selling price increased, but our cost of revenue from operation remained constant. Naturally, so GP ratio will increase. Similarly, lower cost of revenue from operations. Our cost of goods sold, the lower cost is very low, but our selling price constant. Okay, earlier one selling price increased, cost of goods sold constant. Here cost of goods sold constant, but selling cost of goods sold increased, lower. Sorry, selling price constant. Okay, that is the difference. So the combination of both also you will get reason for increase in gross profit ratio. So gross profit ratio will decrease if the above reasons reverse. The same manner. So what is the reason for increase in gross profit ratio? The reverse manner. So naturally what happens? So higher, lower selling price. So naturally what will happen? Gross profit ratio will decrease. Okay. So then increase of our cost of revenue from operation also decrease in gross profit ratio. That is the reason for mentioned here very clearly. Okay, then. So what is the meaning of net profit ratio? A second important one. It establishes the relationship between net profit and revenue from operations. When you know final accounts, our calculated profit or loss according to our from the gross profit with indirect expenses. Okay, the same manner here. It shows the percentage of net profit earned on revenue from operations. So what is the formula here? It's nothing but net profit after tax divided by net sales into 100. Here expression everything in percentage. Okay, that's why you should be very careful that multiply with 100. Okay, then. What is the objective and significance? The net profit ratio is an indicator of overall efficiency of the business. Higher the net profit ratio, better the business. That's what every company should very much careful about. What is the net profit? Our company's net profit. So what we are going to increase? Okay. So that's why it gives overall efficiency of the business. Okay. It helps in determining the operational efficiency of the business. This net profit ratio. A comparison with the industry standard is also an indicator of the efficiency of the business. Okay. So an increase in the ratio over the previous period shows improvement in the operational efficiency, and decline means otherwise reverse. Okay. That's why the net profit ratio very, very important. After that, the gross profit ratio. Okay. Then our third very important ratio, return on investment, also you can call return on capital employed. The same thing we discussed earlier in our shareholders fund. Okay, our proprietors fund. Okay. So shows the relationship of profit with capital employed. So profit here, profit before interest and tax. Here what's the meaning of profit before interest and tax? We once available profit, we still not yet deducted our interest and tax. Okay, before deduction of interest and tax, what is available profit? That is called profit before interest and tax. Okay, so what is our capital employed? The net result of the operation of a business is either profit or loss. Okay, for this return on investment, we want to know. So what is our next result? Profit or loss ultimately. So funds used in the business is to earn profit or loss of proprietors or shareholders funds and loans. Okay, that's why the capital employed means how shareholders spend, how they invested in the business. Ultimately, how we are earning our profit. Okay, so the profit is increased or decreased. That's why the return on investment, return on capital employed, we are going to calculate. Okay, here see what are the ways the return on investment, maybe our investment from the capital. Then it shows the success of the business. What is our return? Okay, investment. So naturally from the sales, then interest calculation, all this calculation based upon this return on investment. Okay. Here what is the formula here? Return on investment, nothing but our earnings before interest and tax, and dividend also divided by capital employed. Okay. So these are the very important formula here, return on investment, also called return on capital employed. Okay. See here. Here we can also discuss both way how to calculate capital employed. This same manner we already discussed our properties fund, correct? So liability side approach and asset side approach. From the liability side approach, how we are going to calculate capital employed. So we have to consider shareholders fund. Okay, nothing but our share capital, resource and surplus. The share capital here also equity share capital and preference share capital. And what is the non-current liabilities? Like you take long-term borrowings and long-term provisions. Okay. Similarly, coming for asset side approach, non-current assets, we can classify it into fixed assets. Okay. Here non-current trade investment, similarly long-term loans and advances. Then working capital we have to consider it. Okay. Here what's the difference? What is meaning by working capital? Nothing but current assets minus current liabilities. Okay. That's why liability side approach or asset side approach. So from the given problem, so the according information, we have to choose whether you have to calculate capital employed from the liability side approach or our asset side approach. Okay. So what is the objective and significance of our return on investment? Okay. Here assess overall performance of the enterprise. Okay. So measures how efficiently the resources the business are used. Okay. So return on capital employed is a fair measure of profitability of any concern, with the result that the performance of different entities may be compared. That is very, very important for our to assess overall performance of the enterprise. Naturally, how efficiently the resources are realized in our business. That's why capital employed. So each and every money is very important on the business. That's why this is very, very important ratio for us to calculate under the profitability ratio. Okay. Okay, first we are going to discuss gross profit ratio. Okay, so from the given example, compute the gross profit ratio from the following information. Revenue from operations 6 lakh, gross profit 25% on cost. Okay, here should be very careful. The given gross profit 25% on cost. Okay, so how to calculate gross profit ratio? Okay, as you know, we have to substitute gross profit ratio, gross profit divided by revenue from operation into 100. Okay. So we are going to calculate now gross profit. So how to calculate revenue from operation minus cost of revenue from operation. Okay, that is the substitution of formula from the available information. So here they given just profit is gross profit 25% on cost, but available information is revenue from operation, not from the cost of revenue from operation. That's what we're going to discuss now. How to calculate cost of revenue from operation. Consider let cost be 100, then gross profit is nothing but 25. So naturally our sales is 100 plus 25, 125. Okay. So if when you substitute this, they given the revenue from operation 6 lakhs. So if it is 125 is 6 lakh, what is our 100? Okay. If you write like this, you can easily understood the information. Okay. So cost of revenue from operations, nothing but the cost of goods sold, 6 lakhs into for class multiplication here 100. Okay, 100 divided by 125. So we get 4 lakh 80,000. That is the our cost of revenue from operation. Now what is our gross profit? So we have to substitute revenue from operation minus cost of revenue from operation. Okay, so 6 lakhs minus 4 lakh 80,000, so you get 1 lakh 20,000. Okay, now we are going to substitute gross profit ratio. So gross profit divided by revenue from operation into 100. Okay, so 1 lakh 20,000, just now we got it, our gross profit divided by 6 lakhs into 100, you will get it 20%. Here the very important discussion point is how they given from the problem. See here they given gross profit 25% on cost. Okay, whether you have to be very careful whether it is on cost or on sales. Okay, that is the idea here. Then move for our next problem. Okay, so example 2. So calculate gross profit ratio from the following. The given cash sales are 25% of total sales. Okay, purchases 6 lakh 90,000. Then credit sales they given 6 lakhs. Then excess of closing inventory over opening inventory 50,000. Okay, so these are the 4 information they given. So they are not given directly total sales. They given just cash sales are 25% of total sales. Okay, but they given only credit sales. From the credit sales, how you are going to calculate? Okay, so they, as you know, substitute the gross profit ratio. Gross profit divided by revenue from operation into 100. Okay, so revenue from operation is equal to here nothing but our net sales. Okay, what is our net sales? Credit sales plus cash sales. Okay, so naturally consider net sales be X. So what is our credit sales given from the problem 6 lakhs? So what is our cash sales they given? 25% of X, nothing but you can consider X divided by 4 for the equation. Okay, when you form the equation, okay, X is equal to X is what our total sales. As we know our cash sales X divided by 4, 25% of our total sales. Okay, that's what X divided by 4 plus our credit sales we know 6 lakhs. Okay, so when you form the equation 4X is equal to X plus 24 lakhs. Okay, multiply by both sides. Okay, 4X, then here also equally make it for 4. 4X is equal to X plus 24 lakhs. Okay, so naturally 4X minus X 3X we get 24 lakhs. And what is our X? X is our 8 lakhs. Okay, so now we're going to substitute what is our cash sales. From the total sales 8 lakhs, 25% is our cash sales. When you apply the 25% percentage from the problem given, you get it 2 lakhs. Okay, now cost of revenue from operation, nothing but cost of goods sold. Here, how we are going to calculate? Okay, they given purchases plus changes in inventories. Okay. So what is our changing inventories? We know difference between opening inventory minus closing inventory. Okay. So from the problem they given purchases or purchases 6,90,000. Okay. So what is our excess of closing inventory over opening inventory? The differences they given directly from our problem 50,000. When you substitute this 6,90,000 minus 50,000, we get it 6,40,000. Okay. Now what is our formula? You know, gross profit revenue from operation minus cost of revenue from operation. So once you know revenue from operation 8 lakhs, just we got it. 6,40,000 cost of revenue from operation. We get it 1,60,000. Okay, now we got it. What is our gross profit? Now we are going to apply the formula. What is gross profit ratio? Gross profit divided by revenue from operation into 100. Okay, so we know already the gross profit 1,60,000 divided by 8 lakhs. Okay, into 100. So we got it 20%. Okay, so here the only thing, the calculation of gross profit only, we should be very careful to find it from the available information. Okay, so we have to read the question carefully. Okay, then our example 3. Calculate gross profit ratio from the following information. Okay, so what is the average inventory? Here they given 1,60,000. Okay, inventory turnover ratio they given 8 times. Here they given inventory turnover ratio 8 times. Then average trade receivables they given 2 lakhs. Okay, then trade receivable turnover ratio, relativity of our receivable, trade receivable. Okay, they given turnover ratio 6 times. They given same manner cash sales 25% of net sales. Okay, we don't know our net sales. So how to calculate? So as you know our gross profit ratio formula, gross profit divided by revenue from operations into 100. Okay, so cost of revenue from operation, so nothing but cost of goods sold we are going to calculate. So from the information we know our average inventory, then average inventory turnover ratio. Okay, so we know already what is our average inventory 1,60,000. So what is our inventory turnover ratio 8 times. So we have to multiply, we get it 12,80,000. Okay, that is our cost of revenue from operation. Okay, then again credit sales also you can taken from our trade receivables. Okay, average trade receivables into trade receivable turnover ratio they given. So 2 lakh into 6 times. Okay, trade receivable turnover ratio. We get it 12 lakhs. The 12 lakhs is what? 75% of our net sales. Okay, that's what our credit sales. So what is our 100%? Okay, once you know 75%, well, what is our 100% revenue from operation? Nothing but credit sales into 100 divided by 75. As you know, our credit sales 12 lakhs. When you convert it into 100%, how much? Okay, 75% is 12 lakhs. What is 100%? When you do like this, 12 lakhs into 100 divided by 75, you get it 16 lakhs. Okay. Now, what is the gross profit formula? So revenue from operation minus cost of revenue from operation. When you substitute this, so we know just now we got it revenue from operation 16 lakhs minus cost of revenue from operation is 12 lakh 80,000. We got it 3 lakh 20,000. Now apply the formula gross profit ratio, gross profit divided by revenue from operations into 100. Okay, so 3 lakh 20,000 divided by 16 lakhs into 100. So 20%. Okay, that's what our gross profit. Now moving forward, net profit ratio. How to calculate net profit ratio? Same manner. Okay. So from the information they given, gross profit ratio of company was 25%. Okay. It cash sales were 2 lakhs and credit sales were 90% of total sales. So total sales or credit sales were 90%. Okay. Therefore, they given the information only cash sales. How to calculate their total sales? That is the idea. If they have indirect expenses of the company were 20,000, calculate net profit ratio. So positive duty, what's our formula? Net profit ratio, net profit divided by revenue from operations, nothing but our net sales into 100. Okay. So what is our total revenue from operations? They're not given directly. That's what we're going to calculate now. So total revenue, nothing but our cash sales plus credit sales. Okay. What is our cash sales? 2 lakhs. From the problem they given. What's our credit sales? So 90% of the total sales. Okay. That's what they given. So how to calculate? From the 90% of total sales. Okay, so cash sales were 10% of the revenue from operation. Okay, so revenue from operation naturally what? So cash sales divided by 10 into 100. Okay, as you know, our cash sales is 2 lakhs. So that is a 10% of total sales. So what is 100%? Naturally, 20 lakhs. So that is the calculation here. So now you know what is the gross profit ratio. The company, the given gross profit ratio of company was 25%. Okay. So what is our 20 lakhs? What is our 25%? So 5 lakhs. Okay. That's what they given here. Once you know our cost of revenue from operation, easily you can go to calculate gross profit ratio. Okay. From the available information, 25% they given. So 25% is our 5 lakhs. Okay. So what is our net profit? So now we want to know what is our net profit. So once you got from gross profit, direct indirect expenses, they given 20,000 direct. So 5 lakh minus 20,000. You got your net profit 4 lakh 80,000. Now apply the formula. So net profit divided by revenue from operations, nothing but net sales into 100. So once you substitute 4,80,000, see 4,80,000 divided by 20 lakhs into 100. So we got it 25%. Here, so the calculation is very, very important. Okay. So for simplification, we get 25%. Now moving for our example 2 for net profit ratio. So from the following information, calculate net profit ratio. So here the revenue from operation nothing but 5 lakhs. Okay. So gross profit 2 lakhs. Then salaries and wages 45,000. Okay. Advertisement expenses 10,000. Interest 5,000. Rent they given 60,000. So here, what is our formula net profit ratio? Net profit divided by revenue from operations, nothing but net sales into 100. Okay. So net profit is equal to gross profit minus indirect expenses and losses plus other income. Okay. So now, so we get it net profit very easily. So from the indirect expenses, nothing but here from the problem they given salaries and wages. See from the problem they given salaries and wages, advertisement expenses, interest. Okay, that's what we're going to substitute here. See here salaries and wages, then advertisement expenses, interest. So add all three together, you get 60,000. Okay, when you go for the calculation, gross profit minus indirect expenses and losses plus other income. Okay, so what is our gross profit? 2 lakhs minus our indirect expenses total is coming 60,000. Okay, then other income also 60,000. We get it 2 lakhs. Okay, 2 lakhs minus 60,000 indirect expenses plus for indirect income. So finally we got it net profit 2 lakh. Now apply the formula net profit divided by revenue from operations net sales into 100. Okay, 2 lakhs divided by 5 lakhs into 100. Okay, so we get it 40%. Okay, that's whatever. So very easily you are going to calculate it here. Okay, now moving forward, return on investment, nothing but return on investment or capital employed. Okay, so very important formula here. Our third classification, our third ratio of our profitability ratio. Okay, so calculate return on investment from the following information: net profit after interest and tax. Okay, they given. So 6 lakhs. Okay, then 10% debentures, 10 lakhs. Okay, tax they given 40%. Capital employed they given 80 lakhs. How to calculate return on investment? Okay, so net profit before interest, tax and dividend. Sometimes they given dividend, we have to add. That's why they mentioned here. So divided by capital employed into 100. Okay, so here what is our net profit before tax? We don't know. So we consider as 100. So net profit after interest and tax. Okay, so 100 the 40% tax they given. See from the formula, from the information they given tax. So naturally consider my profit is 100, tax is 40. Then naturally 60 rupees is my net profit after tax. Okay. So now how to do this? Net profit before tax is for 6 lakhs. So into 100. So 60% is my profit. So what is my 100%? That is the idea here. 6 lakhs into 100 divided by 60. We get it 10 lakhs. That's what our net profit before interest and tax. Now we're going to calculate interest. Okay, so 10 lakhs net profit before interest. Then what is our interest? So 10% debenture. See from the problem they given 10% debenture, 10 lakhs. So once you apply here 10 lakhs into 10%, okay, you get it 1 lakh. That's what our net profit before interest and tax. 10 lakhs, nothing but then 1 lakh our interest, so 11 lakhs. Okay, then return on investment. So net profit before interest, tax and dividend divided by capital employed into 100. Once you substitute here, so 11 lakhs is just now we got it, net profit before interest and tax, okay, divided by 80 lakhs into 100. We get it 13.75%, 13.75% for our return on investment, okay, from our capital employed, from the business, okay. Then, moving forward, then other example. From the following information, calculate return on investment or capital employed, okay. Here also they given some more information. So net profit after interest and tax 1,20,000. So they see here we should be very careful to see whether they given net profit before or after. Okay, that's why the after before. It's a very very important keyword here. Here net profit after interest and tax 1,20,000 and tax is whatever 1,20,000. Okay, here both the figures are same. Should be very careful. Okay. So net fixed asset 5 lakhs. Then long trade investments 50,000. For current assets 2,20,000. Then equity share capital 5 lakhs, 50,000, sorry. 10% preference share capital, 50,000. Then our reserves and surplus, 1 lakh. Then current liabilities, 1,70,000. Then our 12% debentures, 4 lakhs. Okay. So these are the available information. Now moving for our calculation. So first year we are going to discuss net profit before interest and tax, how to calculate. So in our problem they given net profit after interest and tax 1,20,000. So again we want to add back our interest. Okay. So what is our interest? That's what the given problem. Our interest on debentures. Okay. 4 lakhs 12%. See here the problem they given. 12% debenture. Okay. So 12% debenture we got it 48,000. Okay. Then we want to add back again for interest. Similarly, tax they given from the problem 1,20,000. Okay, see here 1,20,000. So naturally we want to add. Okay, so we want to add all net profit before interest and tax and our okay. So all add here net profit and our interest and net profit before interest and tax coming under 2,88,000. We added all the information. Okay. Okay. Then, out we are going to discuss our capital employed in a liability side approach. Okay. Here, what is the idea here? We are going to consider both side liability side approach and our asset side approach. Okay. So, capital employed, how to calculate a liability side approach? That from the liability side, they given from the problem equity share capital 50,000. See here, once again I will show you here. They given okay the preference equity share capital 10% preference share capital reserves surplus current liabilities and 12% debentures. Okay, see this is information we considered here. Okay, so equity share capital 50,000, then reserves and surplus 1 lakh, then our preference share capital 50,000. So you got it shareholders fund 2 lakhs. Thereafter you want to add long term borrowings, nothing but our 12% debenture 4 lakhs. Okay, now what is the our capital employed when the liability side approach? Here 6 lakhs. Similarly, how to calculate your asset side approach? Here one side is another liability side approach or asset side approach. Only here for understanding purpose you want to know both how to calculate. Suppose sometimes the sum they given only from the liability side only. Okay, then how you have how you have to do liability side. Sometimes they given only asset side. That's why you want to know here both side. Okay, asset side approach. Okay, a net fixed asset 5 lakhs. So working capital as you know current assets minus current liabilities. From the problem they given 2,20,000 minus 1,70,000 current assets minus current liabilities. We get 50,000. So long term trade investment 50,000. So capital employed 6 lakhs. That's why both side we see here both side from the liability side also capital employed 6 lakhs. From asset side approach also we get it 6 lakhs. Now we're going to apply the formula. So net profit before interest and tax and dividend capital employed divided by capital employed into 100. So you'll get return on investment 48%. Okay. Now moving for the next example. So from the following information, calculate return on investment. Okay, same manner here. Should be very careful. Net profit before tax. Here they give net profit ratio 25%. Okay. Then they given tax rate 50%. Then revenue from operations 9 lakhs. Net fixed assets 4,50,000. Then accumulated depreciation 1,12,500. Non-current trade investments 45,000. Then current assets 90,000. Total debts 4,05,000. Then 15%. Long-term borrowings 3,60,000. From the available information, we're going to discuss return on investment. So as you know, you have to apply the formula first. So better you always write the formula first. Then only you want to know so which you have to do, work out the ideas. Okay. So here net profit before interest, tax and dividends divided by capital employed into 100. Okay, here they given first calculation. Net profit before tax. From the problem they given 9 lakhs. Okay. So then the rate also they given net profit ratio 25%. So naturally what is our net profit? 2,16,000. Okay. Thereafter net profit before interest and tax. Okay. A net profit before tax. Then we want to add our interest on long-term borrowings. Okay. So we know already our 3,60,000 our see here 3,60,000 our 15% long-term borrowings. Okay. Long-term borrowings. Okay, so 15%. We get it 54,000. So 2,16,000 plus 54,000, we get it 2,70,000. Okay, so current liabilities, now total debts. Here, how to calculate current liabilities? For we are going to discuss by working capital, correct? So total debts minus non-current liabilities. Okay, what is the total debts? 4,05,000 minus non-current liabilities 3,60,000. Naturally, you get it current liabilities. Okay. So what is our capital employed here? They given information all from the asset side. Okay. Here net fixed assets plus trade investments, then minus then add working capital. Okay. That's why net fixed assets 4,50,000. See here from the problem they given. So 4,50,000. Okay. Then here as assets, the accumulated depreciation already deducted. Okay. So what happened? You again going to deduct for 50,000 minus 1,12,500. That you won't do because from the information it clearly mentioned net fixed asset. Okay. So you need not once again deducted accumulated depreciation. Very careful. That's why they given, to confuse you, they given accumulated depreciation. But they given net fixed asset. So you consider here only for 50,000. Trade investments 45,000. And working capital nothing but current assets minus current liability, you get it 45,000. Okay. So once you add all 4,95,000 or net fixed assets and trade investments, then working capital 45,000. We got it 5,40,000. Okay. Now return on investment. Okay, what is the formula here? We know net profit before interest, tax and dividends capital employed into 100. Okay, so as you know now, 2,70,000 our net profit, just now we got it. Then our capital employed is what? 5,40,000 into 100. We got it 50%. 2 times of our 270 become 54. Correct? So 50%. Okay, so that's what our idea here. So this video discussed our gross profit ratio, our net profit ratio, thereafter return on investment or capital employed. Okay, I'm going to discuss our subsequent video for our operating ratio and operating profit ratio. That is also very important. That we're going to discuss our next video. So thank you very much.